What's going on, guys? We got an exciting video today. Today I'm going to go over 3 buys I went ahead and went through today. And as you can already see, one on screen is going to be Meta. And this one is exciting for a few reasons, even though it's kind of a small buy. So I'm just going to kind of go through my buys I did today. And I'm going to go through some of my reasoning. I got some snapshots from some of the earnings. And we're just going to talk through it. So starting off with Meta. So I know it doesn't look like a very exciting buy, just a quarter of a share. This is actually my largest position in my portfolio. It's been the largest since I bought pretty heavy back in 2022 when they had that big crash in Meta, and the stock has done nothing, and the company in general has done nothing but impress me the whole time with Zuckerberg's execution. So I've been happy holding the stock. I haven't sold a single share since I bought in 2022. And now this is insane because my portfolio, if you could see, it is very heavily allocated from Meta. Not really by design, but I did buy pretty heavy, but then also the stock just appreciated so much that it grew into such a large position and became my largest position in my portfolio currently. So for me to go and buy more, that kind of says something. And right now I'm just kind of nibbling a bit in a bit. My strategy right now is I put in about 300, or I do put in $300 a week consistently, whether the market's up or down, and I make buys every week. And the only thing that changes is I pretty much keep it at that 300. That way I have a surplus of cash building up. And whenever we have any big market falls or anything that I see that's just too big an opportunity to pass up, then I have that extra cash as kind of a little safety net pocket that I can throw in the market if I need to go heavy and I need to maybe put a couple $1,000s in at once because I see something at a price that I can't pass up. So that's kind of my strategy. So right now it's not at a price where I need to go, I feel, all in like that or go extremely heavy. So right now I'm fine just slowly adding a bit in a bit every week as part of my regular normal buys. And just to kind of go on the reasoning for this, so if y'all haven't seen the latest earnings, the earnings were really good. They were actually amazing. A lot of it got hit just because Zuckerberg's kind of going a little crazy with the spend again. And also the other thing is a one-time tax that hit their numbers, which made their net income look way more depressed than it actually was. But honestly, I don't find that as much of a concern. And let's go ahead and just move on to the next slide because I could ramble on forever and ever. So this is insane. So if we look at their advertising business, the biggest part of their business, year on year, they grew 25.6%, which this is a multi-trillion-dollar company. That's ridiculous to grow at a 25.6% clip when the numbers are this big on your revenue. We're talking about 39 billion to 50 billion. That's insane. That's so crazy for a company of this size to still be able to grow that much is unheard of. Another great thing I'm seeing, the reality lab side, which I know a lot of people don't pay attention to this or they find it more on a drag of a business because of how much it loses. But that one was up 74%, which I think in a large part is due to the Meta Ray-Bans actually doing well. And this is something where I actually do like that they have the reality labs because they generate so much from their family of apps section that they're able to kind of just sustain this reality labs, and it really is an underlying growth catalyst or a potential growth catalyst because right now it's not very noticeable in the numbers. The numbers are too large, but I think 10, 15 years down the line this could become another major business segment that just launches a company into higher and higher market caps. And in my personal opinion, I do think that Zuckerberg knows what he's doing here. And I do think AR glasses are more than likely going to be something that is an addition to your phone. Originally, I thought maybe they could replace your phone and then everybody was going to switch more to like an AR glasses that they use every day. But now I'm starting to think you'll probably still have your phone. You'll have your iPhone, your Android, whatever you have. But in addition, people are going to start adding as another piece of equipment their AR glasses. And as much as I like the VR side, I think the AR is a much bigger deal because with the AR glasses, I think that's going to have a lot of good use cases for work as well. Like for me, as an example, I work as an accountant full time, and I often use 3 screens at the same time anytime I can. Now, this is great when I have a setup, but sometimes I'm on client side, and yeah, I can bring like a portable monitor, but it really isn't the same. If I was able to have a really good form factor with a long battery life, some AR glasses where I could connect them to my work laptop and I could project the screens and I could have 4 or 5, or maybe if I need a PDF, if they have some haptic technology type thing where I could actually grab and reference the file right here as I'm working on my other working papers, that would be extremely helpful and efficient. And I think that has a lot of use cases as well as entertainment value. So I do think eventually that's going to get bigger. I think this is just something where the technology is going to have to develop farther along. But with how fast things are moving right now, 10 years, I think within 10 years, which sounds like a long time, but 10 years goes by like nothing. But anyways, so revenue up 26%, which is again insane as a total. Like that's just ridiculous. But we've already been through that. I don't want to ramble too much here. I circled this because their operating margin did fall, which is something that could be as some concern for other investors, which is kind of part of the reason why the stock has started to depress in recent weeks. And the capex. Let's talk about the capex. So we can see 24 billion year to date, now to 50. I didn't even have to put any percentage numbers or run the calculations because you can just see how big and how drastic that is. Now, I'm personally not worried about this because I think Meta has done more than enough to prove that they can get the return on this capex to justify this spend. We just saw the revenue growth rates. It's very clear that this capex is paying off. These data centers they've been building out and they've been spending to build heavy and heavy. And from the call, Zuckerberg feels that they need much more capacity, that they still don't have enough capacity to meet demand. So I trust Zuckerberg. He's one of the great founders, great CEO, and he's done nothing in the past few years to make me doubt him. So if he thinks this is the right call to increase the capex and keep going, I say go right ahead, up it as much as you need to. I leave it to him. I'm 100% fine with this. They've proven they can get the return they need from this capex to keep going. Now, one more thing, and then we'll move on to the next company. So now, if we're looking at the average revenue per person, this was up 17.7% year on year, which this is just really, really telling because when you have something like this and they're able to generate more revenue per person, this is telling me that, okay, advertisers that are going to potentially advertise on the platforms, they're willing to spend more on Meta's platforms, or they're spending in larger volumes because they're getting the higher return. They wouldn't be spending more and more if they weren't getting the best return or one of the better returns. No, I will say Meta does give the best returns for advertisers, and it shows in the numbers. And this is just another metric you can see, and this will continue to tick up and up, and it's going to go great. Also, one other thing, I didn't include the slide on the daily active users, but that was still growing, which is kind of ridiculous considering they have half the world's population on their apps. So yeah, I don't know how they continue to grow like that, but it is insane. And one other thing we're going to look at, another big reason. So I have it pulled up on Stock Unlock right here. And obviously we can see the fall it's had in the 20%. Wow, has it already been 20% in a month? Insane. Anyways, yep. Whenever I was looking at this forward PE of 20, that's just, the company's growing 26%. Some of the best margins in the industry. One of the safest companies, I would say. A much larger company. This isn't like a risky, like penny stock. This is Meta. Trading at a forward PE of 20 while it's growing its top line by 26%. And really proving that its capex spend is giving that ROI that we need. So, yeah, for me, that's how I look at it. Whenever I bought Meta back in 2022, a big thing that made it so easy for me to buy is what did that forward PE get down to? I feel like at one point it was below 10, or it was getting close to that. And I was like, this is ridiculous. This is like utility prices for one of the best tech companies. And they're doing it again. And people are going to sell out in droves and droves. And they're going to make a big mistake again. And I'm just going to continue loading up and building my position. Like I said, it's already a large position, so I can't be too aggressive. But honestly, I find this being a great investment. And this is a stock I can genuinely say there are a few stocks I have where I will say, like, there's next to no chance I'm selling this anywhere close to anytime soon. But this is one of those ones that I will probably either hold for life or hold till retirement. I genuinely don't think I will ever sell these shares, short of the stock just becoming extremely overvalued. But no, yeah, this is such a great company. There's nothing they could do that makes me want to part with it so far. But anyway, let's move on to the next one, which y'all probably already saw. We have the Honest Company coming next. Now, this one was also a small buy. Like I said, I was allocating that 300. I have a little bit left over, so I'll see. Maybe I'll pick up more tomorrow. But we'll see. But I got 25 shares. I filled that at $2.60. And Honest. Really, this one is just kind of a turnaround play. Kind of like my third one you're going to see here. It's a turnaround play, and the company is, I want to say, more protected. And we'll get into what I mean by that. So first off, the stock's been falling off, obviously. And you can kind of look, like the updated outlook is pretty bad, which kind of explains the fall the stock has had recently. As well as the fact that the company's basically forecasting they're going to have lower revenues because they are exiting out of their lower profit lines, which I personally like. Like, get the margins up. That's fine. We can deal with that. It's going to hurt the numbers year on year for maybe 1 year. But then after that, you'll be able to come back to growth with higher margin. And at the end of the day, we care about that money hitting the bottom line. Revenue growth for the sake of revenue growth, when you're losing money on that revenue or you're breaking even, it doesn't mean anything. It just leads to bloat in the company. It leads to inefficiencies. So I'd rather them have it be a clean slate. Carter's done a great job so far, so I'm fine with that. Not much to say on that one. And then right here, they kind of all, obviously, like I was saying right now, they just kind of summarize it here. Also, another thing that makes me comfortable to buy more. I already have a decent position built, but just adding more positions, thing that makes me feel really comfortable is this balance sheet. If you've seen, there's a great interview with Peter Lynch, and I believe he was talking about Kaiser Industries. I might be remembering the company wrong. But it was basically a stock he was buying that was falling and falling. And he basically looked at it, and the company had like a couple $100 million worth of assets and no debt. And in his words, it's like, it's kind of hard for a company to go bankrupt with zero debt. And that's kind of honest right now. They don't have any debt on their balance sheet. They have enough cash, just cash on hand, to pay off all their liabilities. So, yeah, the stock price may be down, but I feel fine with holding the company just because of that. Because they have that balance sheet that just holds on, and it gives you that safety net. And then also, they have $71 million of cash, no debt, and the stock's trading at like what, in the 200 millions for the market cap? Yeah, under 300 million for market cap. So for me, I'm fine picking that up. I'll keep it as a long-term hold for now, and I'll just keep paying attention to how the numbers roll out in the future quarters. Now, finally, y'all could all see this one. I'm sure people know what this one is. I do talk about this one a lot. But this is my favorite stock that never moves. And, I'm actually curious. Hold on, I'm going to check on my phone real quick. I wonder if I'm up on my shares or if I am break even or not. Let's see. Sorry, give me one moment. After this fall, I might finally be... I'm down 2% now. But that's alright. Yeah, so PayPal. I know the stock feels like it never moves, and I know it sucks, but you always got to remember with some of these stocks, you got to focus on the fundamentals. You really do. There's so many stocks out there that don't move for a long period, and the fundamentals will improve, and then when they finally do start to make that move, it happens very rapidly. And just like that, you can miss out on 20, 30, 40%. And I know a lot of people always say like, oh, but the opportunity cost because you're holding this stock that hasn't moved for like a year, 2 years. And yes, I kind of get that, but you're more of getting an opportunity to pick up more shares in that time. Because let's say the stock hasn't moved for like 2 or 3 years, but you keep buying and the stock and then the stock finally does make its move. It goes up maybe like 150, 160% in a matter of a few months. Well, now you've just made up for all that lost time. You beat the market return doing that. And that's something that like you just got to get used to as an individual investor. If you can't handle that, you need to just get into index funds. And I think it was also a Peter Lynch quote where he was basically saying you have to be comfortable with underperforming for periods to outperform in the long term when you're picking individual stocks. And it really is true. It's if you focus too much on the short-term movements, you're going to make irrational decisions. Just focus on what the company is doing. And what is PayPal doing? Let's get into it. So Venmo's having really good growth, which I personally appreciated. I love that. That's one of the reasons I made the buy. Oh, I didn't say how much I bought. One share, 65.56. Okay. Yeah, but Venmo's been having really good growth. And I think there's a real possibility this company starts getting back to double-digit revenue growth, which is going to change how the company's valuation is. It's going to start raising that PE. So there's going to be stock price growth from just the PE multiple expanding as well as the income expanding. Anyways, this is going to be a good growth driver going forward for the company. We can already see that in the numbers right here, which I think is really good. And then the other thing, the total payment volume, as we can see in pretty much every area, it's been steadily increasing quarter by quarter. Wow. I forgot this was a picture. Let me try to highlight. Anyways, yeah, so we got 6, 8, 8, stagnant right there. 8, 12, 14 for the Venmo. This one stayed stagnant at 5, but some of the other ones. And then the payment service provider, 1226. And I believe, if I will remember right, was this part of the Braintree? Sorry, anyways. Moral of the story, the company has the growth going. I believe, if I remember correctly, they grew by about 8% this prior quarter, which, let's see. Forgot to grab that snippet. 7%. Okay. Yeah, 7% in the prior quarter, which I think is fine. We can clearly see it's accelerating with some of their other growth drivers like Venmo. I personally do think the turnaround's working well. I did like the partnership that got announced with OpenAI. And what I don't think a lot of people realize is that, yes, it may not hit the numbers short term, but long term, this is going to be a real good growth catalyst. And I still do like the share buybacks. I know some people feel like it has done nothing because the stock price has still stayed depressed, but I promise you that it's eventually going to reflect in the stock price. The more they get that share count down, they bought back so many shares. I think they are down to like what, 900 million, somewhere around there. And they brought down so many shares that's just going to help accelerate the EPS growth. So it's going to lead to a situation where, let's say they're growing their revenue by 7-8%, the EPS could be up by 15, 16, 17% or more, because you can't just factor in that share buyback. The whole strategic plan that Alex Chris has been implementing whenever he took over in management is focusing more on higher margin revenue, which is kind of why the revenue growth has started to slow, because he's been trying to cut more of those lower margin areas. So we're going to see the margins expanding. Revenue is still growing. It's not crazy growth, but if it does accelerate, that's great too. We're going to see those margins expand, the share count go down, that EPS is going to skyrocket from that. And I think that's going to be an amazing growth catalyst for the stock. And I really do just think it's a matter of time before the market starts to realize that. And you kind of have a lot of the risk taken out because, 960 million diluted shares. You have a lot of the risk taken out just because of how depressed the stock price is. And this is something the margin of safety, something talked about, I believe it was in it was in the Intelligent Investor, and then I'm trying to remember if Joel Greenblatt also mentioned it in the little book that beats the market. But either way, this is just simple like investing 101. The lower the price you pay for a stock, the lower the valuation, the less risk you're taking. You're taking a higher discount. With this sitting at a 12.43 and a forward under 12, you do have a lot of the risk priced out of it in a sense. Short of like some major fraud or some like the company just completely deteriorating, you do have a lot of the risk just factored out. And for me personally, I think that's a good enough margin of safety. And I don't want to ramble too much longer on this just because with PayPal, I know for a fact I made a video running my valuations on it. I think I might have made a follow-up video also just talking about it. But yeah, this stock, I'm just going to continue to slowly add, slowly add. If it falls back, if this falls back to the 50s, this might be like one of the times at the start where I was talking about where I might have to throw a couple thousand in. It really might. And maybe I look back on this in 3-4 years and I was like, that was such a money pit. I didn't like look at something, or it was just a wasted opportunity, but I really don't think it will be. But we can only see, time will tell. So I think I'm going to end the video there. But if y'all have any thoughts of any of my stocks I've picked up, go ahead and let me know down in the comments below. What are y'all picking up? Or are y'all not buying anything? Are y'all holding? Let me know what your moves are so far.